Geez, do you think the U.S. government could maybe be taking possession of 100 million ounces of silver? I don't know. Sure seems that way to me. Ask yourself who stood for delivery for 38 million ounces in the last week on COMEX, and who stood for delivery for almost 70 million ounces last month. And is it the federal government? Is it Tesla, Samsung? We already heard how Samsung's gone to Mexico and dealt directly with the mine by buying doré concentrate. And they're doing it now by standing for delivery, which is a completely legal thing to do. And when you have exchanges that rehypothecate, in other words, sell the same contract over and over and over again, creating tons of volume and extra cash and the ability to, in essence, fleece the market because no one stands for delivery. It's like Bernie Madoff. Everyone was happy with Bernie making big monthly checks until they said, but we want our principal back. How China is going directly to Mexico, the number one producer, China's two, and to Peru, the number three producer, and buying all their pre-refined silver in the form of doré and concentrate, paying double what the West will, shipping it back to China. I am looking at a market that is seeing massive, and I mean massive, deliveries, Daryl, into COMEX. To me, first and foremost, above all else, that's really what matters, because what you are witnessing are the most well-informed traders in the world. Forget about the fact that we're seeing billions and billions and billions and billions come into the market, into COMEX every single month, which no one's talking about in the mainstream, which I just don't get. But the people at that level who have that kind of wealth, they're also connected to the information. They're not doing it just for the hell of it. These people are at the highest level of government, at the highest level of finance and of influence. And when we see what amounts to literally billions every single month coming in, to me, that signals not only that the metal itself is probably worth more than the money being used to purchase it, but it also signals to me that it is a physical delivery that is, I guess you could say, there's a fight going on over real delivery demand over paper promises. And I'll give you an example of what I mean. Now, this is what I'm about to tell you is true of everything we've seen every month since a year ago, November, when Trump won the election.
The real signal here isn't price. It's who is quietly taking possession while headlines stay silent. Andy SCHECTMAN has been pointing out that COMEX inflows aren't retail speculation. They're institutional behavior tied to physical delivery, not paper leverage. Billions moving monthly into one exchange suggest confidence in metal, not currency, especially when delivery replaces rolling contracts. Historically, when physical demand overtakes paper claims, pricing mechanisms eventually break. We saw echoes of this in 2020 and again post-2022 rate shocks. For investors, this matters because paper exposure behaves very differently when counterparty risk rises. And what Andy SCHECTMAN flags next explains why this delivery trend may accelerate rather than fade.
But in the month of December, there was 3,706,000 ounces of gold delivered on COMEX. Well, 3,706,000 times, at the time, $4,300 an ounce. Do the math, you're at, $13-14 billion. And how about the 64,730,000 troy ounces of silver stopped and issued and stopped? That's the same thing as delivered. What's 65 million ounces of silver worth at $80 an ounce? And if a mint box of silver maples or eagles weighs 42 pounds, what does 65 million ounces weigh? And at this level, it's not even the money, Daryl, as much as it is the information that is pushing these people to do it. Now, this has gone on again. Here we are in January, and we've seen roughly 6 or 7 days on the delivery month, which is not a major scheduled delivery month. And yet we've already seen in silver almost 7,000 contracts stand for delivery. About pretty damn close to 35 million ounces of silver has already been delivered in January. So between December And January, you have 100 million ounces of silver that has stood for delivery. Now,
When delivery numbers reach this scale, it stops being a trade and starts being a statement. Andy SCHECTMAN highlights that 100 million ounces standing for delivery across 2 months isn't normal liquidity behavior. It's strategic accumulation. At roughly $80 per ounce, that silver alone represents billions pulled out of paper circulation, tightening available float. COMEX delivery months historically see rollovers, not mass stops, especially in non-major months like January. For portfolio managers, this signals stress building beneath futures pricing, similar to pre-squeeze dynamics seen in other commodity markets. What Andy SCHECTMAN points to next shows why timing here may matter more than price.
there's still another 2 weeks left in the January contract, but this has been going on every single month. And I've been screaming about it on a central bank level since 2020. You go back and watch any of the 6,000 videos I did in that time frame, and you will see this has been a primary thesis of mine, that when the most well-funded and well-informed traders on the planet take possession and remove counterparty risk, stand for delivery at these kinds of numbers, which we've never seen this before on COMEX, never. And where is the mainstream media with any journalistic integrity at all? Where is the idiot Jim Cramer? Where are all of these people who are supposedly doing what's right by the people that they're talking to, and instead they're leading them like the sheep to slaughter? This, to me, is all you need to know. Yes, on top of it, the United States government classified silver a critical mineral. Geez, do you think the U.S. government could maybe be taking possession of 100 million ounces of silver? I don't know. Sure seems that way to me. And forget about the fact that the European Union did it a year ago, and forget about the fact that China, everyone talks about them tightening the noose on exports.
This is where silence becomes the loudest signal in the market. Andy SCHECTMAN has long argued that when delivery behavior changes but coverage doesn't, it's usually because the implications are uncomfortable. Silver's classification as a critical mineral aligns with national security frameworks, not investor narratives. And those designations historically precede government stockpiling. The EU followed a similar path earlier, and China's export tightening fits the same pattern of internal prioritization. For investors, this reframes silver from a speculative metal into a strategic input, a shift that changes long-term risk models. And what Andy SCHECTMAN connects next ties policy moves directly to supply pressure.
Well, what people don't really talk about is what they said in November, which is that we are prioritizing silver for domestic needs before anything else. Then they put on the export restrictions, and they're responsible for refining 70% of the world's silver doré. Yeah, things are getting very interesting. But in terms of the noise and the periphery, what else do you need to know? But that the biggest money in the world who knows the information actually probably creates the information, or is real close with those that do, says, yeah, let's stand for possession every month of billions and billions and billions. And shh. Don't tell anyone. I have to look over my back and make sure, I don't got someone looking to stab a knife in my shoulder, because I've been saying this for months on end now, and, it's happening and it's accelerating. December was the biggest delivery ever in silver, ever, for a month of December in the history of the COMEX market, which goes back to 1974. So,
wow.
I don't know, man. Things are starting to get crazy. And when you see these kind of deliveries instead of paper promises, when you see countries standing to change the rules by implementing strategic minerals lists or tightening exports, this is becoming real very quickly.
When countries that refine 70% of global supply restrict exports, markets don't adjust smoothly. They gap. Andy SCHECTMAN is pointing to a quiet coordination between policy, refining control, and physical accumulation that investors often underestimate. December becoming the largest silver delivery month since 1974 isn't volatility, it's structural change. Historically, commodity repricing follows supply control first, headlines later. Oil in the 1970s is a clear parallel. For long-term investors, this raises questions about exposure, sourcing risk, and portfolio hedging. And what Andy Schectman hints at next explains why this shift may already be irreversible.
When we started the year 2025, silver went from the mid 20s, low 30s early in the year to upper 70s by year end, and now we're trading at almost 90. This is not, and as far as I'm concerned, this isn't just a gradual rise in the price of silver. This is silver repricing and gold repricing, which doubled. And I think these things are beginning to happen. And it's because that there has been, for many years, central bank suppression on both gold and silver in the West. Silver for the military-industrial complex, and gold because of Gibson's paradox, the inverse relationship between real interest rates and gold. So they had a vested interest, they being the Western elite, the central banks, in holding these things down. What makes things very different now than at any time I've ever done this is the ability to stand for delivery. And the countries that are doing so prior to whoever's doing it here in the U.S., these were, I think countries that for many years were not sophisticated or coordinated or motivated or had any interest in challenging the West. And they're doing it now by standing for delivery, which is a completely legal thing to do.
This move isn't momentum. It's a regime shift hiding in plain sight. As Andy Schectman points out here, a near 3x move in silver inside a single year historically aligns with structural repricing phases, not speculative blow-offs. Gold doubling alongside it strengthens that signal, especially when real rates remain restrictive, a condition that normally suppresses metals. Gibson's paradox explains why this suppression worked for decades. But standing for delivery breaks that mechanism by removing synthetic supply. For investors, this reframes silver from a volatility trade into a long-duration macro asset with asymmetric upside. What Andy Schectman explains next reveals why this repricing may still be early.
And when you have exchanges that rehypothecate, in other words, sell the same contract over and over and over again, creating tons of volume and extra cash and the ability to, in essence, fleece the market because no one stands for delivery. It's easy to do, but when everyone says, here's the vulnerability in the entire system and it's about standing for delivery, it's like Bernie Madoff. Everyone was happy with Bernie making big monthly checks until they said, but we want our principal back. And then the whole thing fell apart. Well, it's the same thing here. It's the vulnerability to the Western system that has been exposed by countries that are coordinated and motivated and wealthy and sophisticated that were third world 20 years ago. Now they're not. And this is creating a very, very big problem. Anyone foolish enough to be naked short in this market, I think, deserves what they get. And I honestly believe that we will find that out sooner than later as some of these banks are hemorrhaging. And there's a report out of the Economic Times that says it's the U.S. banks that are long, and that and they have quietly flip-flopped, leaving the European banks and maybe a bank or two in Canada naked, exposed to what could be an existential threat in the rise of metals prices.
This is the quiet flaw Wall Street hopes never gets tested. Andy Schectman draws a clean parallel here. Rehypothecation works only as long as nobody asks for the asset back, just like Madoff's scheme survived until redemption surged. COMEX volume looks deep, but real liquidity collapses when delivery replaces rollover, a pattern we've seen before in stress events like March 2020. The Economic Times report suggesting US banks flipped long while European banks stayed exposed hints at internal recognition of that risk. For investors, this raises counterparty concerns that paper metals can't hedge. And what Andy Schectman outlines next shows who's now forcing that reckoning.
Well, I think the public will be last to the party. The industrial demand, I think, will come to some sort of a very large battle with the big funds, the big money that's doing it from an investment standpoint, who will have a very hard time ignoring the gains that we're seeing in these markets that are blowing through all resistance levels and have outperformed everything. So at some point, ask yourself who stood for delivery for 38 million ounces in the last week on COMEX, and who stood for delivery for almost 70 million ounces last month. And is it the federal government? Is it Tesla, Samsung? We already heard how Samsung's gone to Mexico and dealt directly with the mine by buying doré concentrate. But that's the same thing I've been saying for 2 years now that China's been doing, as I was told by Sean Kuhn, a mutual friend of ours, the CEO of Dolly Varden, and Keith Neumeyer talks about it, how these banks, how China is going directly to Mexico, the number one producer, China's two, and to Peru, the number three producer, and buying all their pre-refined silver in the form of doré concentrate, paying double what the West will, shipping it back to China to refine it.
Retail always shows up after supply is spoken for. Andy SCHECTMAN highlights that 38 million ounces in a week and nearly 70 million in a month aren't speculative inflows. They're procurement behavior. When companies like Samsung bypass markets to secure concentrate directly, that signals fear of future availability, not price chasing. China's willingness to pay double for pre-refined silver mirrors past commodity shortages, where supply security mattered more than margins. For investors, this suggests industrial demand could overwhelm financial flows faster than expected. What Andy SCHECTMAN points to next explains why that collision may redefine pricing.
Well, that's the exact same thing that Samsung is now doing. So you're seeing a situation where at some point the industrials who have to stockpile say, my God, it's going so fast and now everyone's going to buy it. If we don't jump in and take millions of ounces, we could be in big trouble. So you will see the industrials battle I believe, the hedge funds at some point and push the price massively higher. At the same time, now you have the governments involved as a critical mineral and limiting exports. And there are very few commodities that have plurality in use, right? Like you have monetary, you have military, you have industrial, and many forms of industrial. And you have all the players in that game that are all saying, well, geez, I need it. And now you have the U.S. government amongst the European Union and now China, the real big boys and girls in the room who are saying, but we need it too. And so between the industrials, the governments, the investors, and then the retail investors who will get the scraps into a depleting pool of availability, where we're now 6 years in a row in a structural imbalance between supply and demand. Only about, 18% of what was mined last year, of the 800 million ounces, only about 160 million of the 800 million came from companies mining silver. That's it.
This is where price discovery stops being polite. Andy SCHECTMAN is effectively describing a four-way demand stack: governments, industry, funds, and retail, fighting over shrinking supply. 6 consecutive years of structural deficit matters more than any quarterly price chart, especially when only 18% of silver comes from primary mines. Byproduct supply can't scale quickly, which means shortages don't respond to higher prices the way oil or copper can. For long-term investors, this sets up volatility driven by scarcity, not sentiment. And what Andy SCHECTMAN explains next is why latecomers may only see what's left over.
The rest of it, and less than that, comes from byproduct mining of copper, lead, and zinc. And so, yeah, it's becoming something where demand is massively increasing, hasn't hit the mainstream yet for the retail public, but it's being driven by the highest money in the world at a period of time when we're going deeper and deeper and deeper into an imbalance between supply and demand. And it's coming out of the ground at 7-to-1. In other words, 7 ounces of silver for every 1 ounce of gold, yet it's still priced at upper 50s, 56-to-1, but it was at 120-to-1 in March of 2020. It was at 85 or 90-to-1 most of the last several years. So it's beginning to move back towards not only its historical ratio, and everything always does regress to the mean, regress to the average. How low does it go? Don't know. But if you told me that it would regress into 30-ish to 1 or 20-ish to 1, I mean, that's totally logical and still many times higher than it's being pulled out of the ground at and depleting, disappearing. So you look at all the silver used in military applications and industrial applications, and the military applications have blown up, and the industrial applications, because such a small amount is used, most of it doesn't get recycled. It's in landfills. So it's depleting.